Hi, welcome to another episode of Coffee with Alissa. Today I'm joined by two of my colleagues, Jess Ellicott and Courtney Moriarty, to talk about a really hot topic right now, which is credit cards. Credit card debt so far this year has already soared $45 billion in the first half of 2023 and is now over $1 trillion. So we wanted to spend some time today talking about credit cards, the dangers and the potential benefits. Certainly not encouraging the overuse of credit cards by having this conversation, as you know, it's easy to get into a lot of trouble with debt, but we all have them, we all use them, they're a part of our society. So we want to help you understand them better and maximize the benefits. First, we want to start out by talking about finding the right credit card. You could have several reasons to get one. You may be starting out trying to build credit as a younger person, in which case maybe a student credit card, which is unsecured and easy to qualify for. That might be a good option for you. Or you may be trying to rebuild credit, maybe after a bankruptcy or some other type of issue, and in which case you could apply for a secured credit card. So that usually requires a security deposit of about $200, maybe a little bit more, which is typically returned to you once your account is upgraded to a traditional card or is closed in good standing. So if you have good credit and you use credit cards wisely, maybe you're just looking for a card to use for emergencies, or maybe you have a job where you receive a lower regular salary, but you receive large quarterly commissions, and you might need a credit card to carry you through to those higher earning months. So Courtney, can you tell us a little bit about other credit card benefits that might be useful to this type of person?
Yeah, so if you're a kind of person that kind of needs to spend more in the short term than you can pay off in the next month, like the scenario you talked about, Alissa, or for example, one of my friends wanted to do some renovations to her house this summer before it got cold outside, but she wanted to pay it with her bonus that she won't get for another 6 months. So she did something called a balance transfer offer. And this is when you have a credit card balance that you transfer to another credit card using some kind of a promotional rate. So different credit card companies are different, but some will give you as low as 0% APR for an extended promotional period. So it can be up to 21 months that this promotional period can last, and you won't pay any interest. But there are some best practices that need to be implemented in order for this to work. So first of all, you need to be aware of upfront fees. They're anywhere from 3 to 5% of your balance. They're going to get tacked onto the full balance, and you'll have to repay it by the end of the promotional period. Also, you want to make sure that your balance is paid off before the end of that promotional period, because once that period is up, you're going to start paying interest using the typical APR or higher than average. I think the average is in the 20s right now, but you're going to have to start paying that interest if you don't have your balance transfer paid off at that point. Some things you also need to be aware of and be realistic with yourself is if you have trouble paying your credit card bills on time, this is probably not the move for you, because what a lot of credit card companies can do and stipulate in the contract, but a lot of people miss this, is if you miss a payment, even by a day, it can cancel your low promotional APR rate, and it can be replaced with a higher than average APR immediately. And then it just defeats the whole purpose of doing the balance transfer in the first place. And now you also have this extra 3 to 5% fee tacked on to your balance. So just be aware of that. Also, another thing that people make mistakes on with these is making additional purchases on this credit card in which you have the balance transfer on. Because when you carry a balance on a credit card and you make new purchases, it can cancel your grace period. So the difference between a promotional period and your grace period, the promotional period is specific for this promo, for this credit card, right? To get your business in the door, the low APR for 21 months. But your grace period is with any credit card. So if you have a credit card, you have a grace period. By law, it has to be at least 21 days. Some are a little bit more, but it's from the time your billing cycle ends until the date you have to pay that bill. So in that time, you don't pay interest on your purchases from that billing cycle. But if you carry a balance over, including your balance transfer balance, then you're going to immediately start paying interest on any new purchases. They won't give you your grace period. So that is something that people need to be aware of. So it's just try not to make any additional purchases, especially avoid making big ones on this credit card. If I were doing this, I would not take that credit card anywhere. So yeah, just be aware of that.
Yeah, it's so important to remember to make those monthly minimum payments on a balance transfer. And like you said, to maybe set something in your calendar a month or two beforehand and just pay it off a month early, just so you don't forget and then end up getting all that back interest tacked on there, because that could be significant depending on the amount of the transfer. So another reason to get a credit card could be to utilize some of the cashback rewards that are offered from purchasing from specific vendors or merchants. Maybe it's grocery shopping or filling up your gas tank. Jess, can you talk a little bit about the benefits of cashback cards and how to choose the right one?
Yeah, I mean, so we could talk about it forever on how to choose the right card. There's such a big conversation behind this. But I think number one, do your research. Every credit card is different. And so it's so important to really know what you're getting into before you sign up for anything. The very first step that I take when I'm determining whether or not I should get a new card is to kind of review my spending that I've done over the last 3 to 6 months. This will really give you a good idea of where you're spending the bulk of your money, whether it is on travel, through hotel or flights, or even if you're taking an Uber around the city a lot, that can also rack up some good points for you. There's also entertainment cards that cover cash back for eating out, going to concerts, going to movies, and then more of those like crucial needs that Alissa kind of mentioned, which is getting your groceries, filling up your gas tank, or even some cards allow cash back for utility payments. So once you take a look at your finances and really determine where you're spending your money, that's when you can start to narrow down at least what category you want to start looking into. There is a great resource that's for free online called NerdWallet. You can go there and you can say, I'm looking for a travel card, and it will take kind of all of your financial stats and give you the best recommendation for you. So definitely recommend checking out that resource. Otherwise, so there's plenty of options out there. So I'd say when you're in this next step of figuring out, okay, I've figured out what category I think makes the most sense for me, but there's still 15, 20 different cards for me to choose between. I like to start looking at then what those fees are on that card compared to the benefits that they're offering. So for example, some cards will offer a lower tier where they don't have an annual fee, but you get a lower cashback percentage. Or if you go to the higher tier, you are paying that fee with a higher percentage of cash back. So really just taking a look again at your spending and seeing, will that additional percentage of cash back make a difference, and will it be enough to cover whatever their annual fee is? If not, maybe go with the free option because you're still getting cash back and you're not having to pay a fee for it. The other thing that I kind of keep an eye out on is I say beware of the sign-on bonuses. Everyone's all excited because it's like free money. Who doesn't love free money? But it's another way to kind of entice you without really thinking about the long-term spend. So for example, if you end up with a card where you're paying an annual fee and your justification is, oh, well, I get a $200 sign-on bonus, you only get that once. So it'll cover your first year of that card, but then what about the following years that you have to pay that fee? So really just being conscientious of kind of what the long game looks like.
So everyone's done their research, right? They decide on a card, they're ready to apply. Just keep in mind, you can include all of the income that you have reasonable access to. So for students, that can often include money from grants and scholarships and allowances from your parents. For non-students, that can include a partner or spouse's income as well. So Courtney, can you talk a little bit about some other important things about credit card utilization?
Yeah, so when applying for a credit card, you usually have to report your income on that, like you said. So the more income you report, the better, because that means the more credit you will have available to you. They're going to increase your credit availability. However, there is a downside to this. You know, if your behavior isn't quite disciplined and you can get caught in the trap of spending all your available credit or more than you should and more than you can pay off within a reasonable amount of time, and then you're paying interest. So the credit utilization portion of that, so credit utilization is the second biggest factor that goes into your credit score. So it's just a simple calculation. It's the amount of credit you're using, so the amount of debt or whatever, and over the total available credit you have that you could spend. So the lower that number is, the better your credit score will be. So that's why reporting a bigger income, if you can, on your credit application will be beneficial. But again, you don't want to get caught in the trap of spending more just because it's there. The rewards are just not worth it. So a good rule of thumb, I think, is if you don't have the money next month, or if you won't have the money next month, just don't spend it. The way I like to look at credit cards, I have a few different credit cards, and I don't use them as if, I have all this extra money now just because I can swipe it and I can get all these different things now. My spending hasn't changed as far as how much I'm spending. It's just what purchases I'm putting on which cards to maximize my rewards. And I think that's how everyone should look at it.
Well, Jess, often you receive better benefits when you have a higher credit score. I know Courtney talked a little bit about credit utilization factoring into that, but can you leave us with some other important takeaways on how to improve your credit score?
Much like NerdWallet, there are tons of free resources out there for you to go and check your personal score. And then a lot of those resources will say, this is how you can personally make your score better. Highly recommend looking for some of those. I personally use Credit Karma. And like I said, it's great for personalized recommendations of what I can do. But on a more general note, as Courtney mentioned, credit utilization is one of the big factors that go into your credit score. But the other two that are involved is going to be your payment history and then derogatory marks on your account. So, and they kind of play hand in hand. So with payment history, that's all about paying off your credit card in full on time as often and as frequently as you can. Obviously, there are instances in which sometimes that doesn't always work out. Just know that missing that payment, as Courtney mentioned, even by a day could have consequences to it. So a payment missed by up to 30 days can have an impact on your score, but that one is at least a little bit easier to recover from. Whereas if you have a payment that's missed by up to from 60 to 90 days, that is a lot more damaging and could ultimately disqualify you from applying for certain loans down the road. And then if you pass that 90-day mark, that missed payment will be sent to collections, and that will eventually lead to a derogatory mark on your account, which has a very large impact. There are a couple other factors that play into your score that don't have as much of an impact, but are still equally important. Some of those are credit age. So the longer that you have been in the credit game, the better. So that just depends on whatever your oldest credit card is typically. So one of the best things that my parents did for me is when I was in middle school, they actually added me on to one of their accounts as an authorized user, which was super great because by the time I was actually to the age of where I was applying for credit cards and applying for apartments, I already had some sort of credit history behind me. And it made my chances a lot easier compared to some of my peers who were really struggling to get housing and such like that after college. So I highly recommend taking that approach if you have kids that you want to set up for the future. It's a great idea. The other thing that kind of goes into it is the total accounts that you own. So we talk often about how important it is to diversify your investment portfolio, and the same thing goes for your credit accounts. Having different types of accounts, such as credit cards or loans, they add to your credit mix and ultimately help your score. And then the last kind of factor that is looked at is the number of hard inquiries. So these are when you apply for credit in any form. So applying for a new credit card, applying to get a new car, get a mortgage on your home, any of the above will kind of count as a hard inquiry. The good news is that these only affect your credit score for a temporary amount of time compared to the other ones. So if you have too many, it can hurt your score, but they can stay on your report up to 2 years, but eventually fade out over time. And then it usually bounces back within 3 months. So we recommend that if you're going to try and apply for a mortgage or another large loan, that you definitely want to try and minimize the amount of hard inquiries before going into that meeting.
Well, you both shared so much valuable information today. I'm very grateful for that, and I'm sure our audience is too. So thank you for joining me, and to our audience, thank you for watching. Have a great day.